Now, following the 50 basis point MPR hike by the Nigerian Monetary Policy Committee, traders recorded better offers on special bills as bond yields shot up in response. Chuka Nwachukwu, the head of ALM and balance sheet management at UBA, joins me now as we look at the market. Thank you so much for your time today, Chuka. Let's first get your take on how the market reacted to that MPC rate hike there, 50 basis points.
Yeah, thank you. Ken. Market has really not reacted so much. 50 basis point is not, it's really not much. But again, if you notice the pattern of the hiking rate, last year we were about 5 hiking rate, and then that really didn't affect the market. Didn't move the yield as expected. So this actually didn't really affect the market as much as people anticipated, because people thought that the MPC is going to hike rate by about 100 just to maintain what they have been doing, but 50 basis point wasn't too significant to affect the market.
Would you say it was already priced in? And let's look at what's playing out in the yield curve and the activity there in there. How are players positioning?
Yeah, absolutely. It's already been priced in. There are two major activities this week. Aside the MPC meeting, we also had a bond auction on Monday, where we saw about 350 billion was on offer, and well over 535 billion was sold across four maturities of 2028, 32, 37, and then 49. Incidentally, what happened was that there was a decrease in yield, across three maturities other than the shorter end, which is 2028. So we saw that move by 1 basis point from 13.99 to 14%. But the other three, we saw a decrease in yield for between 15 basis point to 70 basis point. For example, the 2037 came out at 15.2 as against 15.9 the previous auction. And so market actually has reacted to this, and that is also because most of these bonds will not be in at the next auction, and so people are just trying to take advantage of this current auction.
All right, let's get your take on what we've seen playing out off our shores here. The big decision from the U.S. Federal Reserve today on that, and what quite a lot of people are looking at is more or less what they will do around the banking crisis. Yesterday, at the MPC, the MPC Central Bank Governor says that the further hikes here will not more or less impact the stability of banks here. Do you share the same opinion, and how are you interpreting the situation here?
If you listen to the CBN governor's communique, and then the decision as regard the 50 basis point hiking rate, you see that this decision was mainly on not only mainly on the inflationary activities, but also they were mindful of the banking crisis you mentioned happening in Europe and in America. And if you look at if you drill down critically on the banking crisis, we discover that most of these banks were affected due to the high exposure, especially on the securities which they've invested in, and that also has to do with this consistent increase in monetary rates, by Fed and then ECB and other monetary bodies. And so CBN was also mindful of that effect, increasing rate in Nigeria. And so for me, really, like CBN has mentioned, for now, I don't see that affecting the bank, not even in the next future.
All right, well, coming back home and looking at what's playing out here, we've seen, yes, the MPR hike was one of the major activities. We also had that bond auction also playing out. But do you think, in terms of how to impact interbank markets, do you think that the rates will remain elevated in the near term?
Yeah, part of what is affecting the rate, actually, especially on the fixed income market, has to do with liquidity. This week, the system has been pretty tight. But again, next week, the system there will be a lot of liquidity next week, especially with FAC coming in. And then going into month of April, we see well over 1 trillion, 1.7 trillion thereabout, coming in the terms of bond maturities as well as a coupon payment. So for me, really, the rate will continue to, first of all, between now and the end of April, the rate will continue to go down, especially with these liquidities I've just mentioned. But afterwards, we expect that the rate will move forward. I mean, will move upward, considering the fact that the federal government is also looking to borrow heavily, in the fixed income market, especially on the bond side. So they obviously have to make it attractive for investors to come in.